Hi, I'm Luis Contreras, a registered investment advisor. And in this video, I'm going to talk about 12 ways the rich don't pay taxes and you can too. Now, before I get started, I myself, you know, I, I grew up in an environment that was, I didn't have rich, uh, uh, in terms of money wise, family or my parents, they are hardworking, taught me a lot of good values in life, but, didn't, in terms of investments and creating wealth, they, they don't know how to do that. They just know how to work hard and be good people, which is a great thing. But now that I'm, a registered investment advisor, financial advisor, whatever you want to call me, I've learned a lot by doing this and by working with clients, and thus also myself doing some of these things that exposes you to a new world, and you're like, wow, there's so much other things that you can do. But if we don't, if people don't inform themselves of these things, well, then of course, most likely you're not going to do them. So I hope you enjoy this video and gain some knowledge about these things that you could potentially do, or people that you know of could potentially do. So let's get started. So the first thing that they do is business entities. So the rich or the wealthy understand that um, the tax code here in the US incentivizes you to have business entities, things like an LLC, partnerships, corporations, S and C Corp, also like nonprofit corporations, charities, foundations, etc., etc. I mean, there's just so many of them. But the tax code incentivizes you to do these things depending on your type of industry. Some may be more favorable than others. Also depends on where you live and in the state where you live, etc., etc. But a lot of tax advantages are in play with certain business entities, and the rich know that. That's why they have a lot of businesses that they own, and things like that. So business entities is number one. So number two is retirement accounts. So the rich and very wealthy, especially since they own businesses, they're able to open up retirement accounts, and they're able to deduct lots of contributions. Retirement accounts, you can deduct, not just tens and hundreds of thousands of dollars, but potentially millions of dollars. Depends on how many retirement accounts you do and how you structure them and your business entities. But tons and tons of potential of tax deduction for retirement accounts, as well as the growth of those funds are tax deferred, so you don't pay any taxes on the growth of those funds. And when you take the funds out, some could be taxable. Depends, if you use traditional contributions or Roth accounts. But the rich know, working with their advisors, that potentially you could offset some of those taxes as well in other ways, and still have it be tax-free in retirement in case you don't use Roths. So lots of ways that you can do it, but they use retirement accounts because of all the tax benefits that retirement accounts have, and they usually contribute lots of money into those accounts. So that's number two. Number three is leverage. So the rich leverage a lot of their assets, meaning that they take out loans on their assets, like lines of credit. They do that with some of their investments, like they have stocks, in bonds, in brokerage accounts, and you're able to do like what's called pledged asset lines or asset-backed lines of credit on those accounts. You could, the rich, also take out lines of credit or loans on, their real estate investments, their businesses. I mean, you name it. They use leverage to get access to tax-free money, because those loans are tax-free. They don't pay taxes on it, and reinvest it somewhere else. And the great thing with that is that you don't have to sell your investments. when you take out a loan on them. So you're not liquidating those investments. So you have your investments growing, plus you have that money and investing it somewhere else, that those other new investments that you're going to invest in also could grow. So, you have double the potential growth. That's why it's called leverage. Of course, there's risks involved, but yeah, that's how you may have heard the phrase, buy, borrow, and die. You buy the investments, you borrow against them so that you don't have to sell them, and then you die and you pass it on to your kids. While you had all that growth in those investments. So buy, borrow, die. So leverage, number 3. Number 4, tax-free bonds. So by tax-free bonds, I'm talking about municipal bonds, or munis is what we call them in the industry. The interest from municipal bonds qualify for federal income tax, tax-free, free of federal income tax, and depends on which bonds you get. They could also be state tax-free. So I live in California, which is high state income tax state. So you could potentially invest in these bonds and get the interest be federal and state tax-free. So that would be great, because here in California, the highest federal tax rate is like 37%. Plus, the state tax rate could put you over, the highest one can put you over 50% total taxes. So, by using the interest, investing in these bonds and getting the interest, you could really save a lot of money and keep more of your money instead of paying taxes. So tax-free bonds. So number 5, real estate. Real estate is a huge one. For a wide variety of tax benefits. I'm going to go just through some of them because there's a lot of them. But with real estate, you can get a huge amounts of deductions by investing in real estate, whether it's short-term rentals or long-term rentals, or even if you're flipping real estate. You could also get one of the biggest deductions is depreciation. So you're able to depreciate and deduct the value of your property that you buy, right? And because of the new tax laws that came into effect, I think it was 2017, there's also like bonus depreciation. So instead of waiting like 27 years to depreciate the value of a property, you could do it a lot quicker, 5 years, 2 years, 1 year. I mean, huge amounts of deductions. You also could get what's called, if you become a real estate professional. Oh, this is a big one. If you become a real estate professional, you could deduct a lot of your real estate deductions and apply them to your ordinary income and deduct them there. That one's a huge one. But you have to qualify as a real estate professional in order to do that. Another one as well that you can do is what's called, you're able to sell some of your properties and reinvest those proceeds into other real estate properties, and all the gain that you got from your original properties, you're able to defer that. And you do that by doing what's called a 1031 exchange. So you buy a property, and let's say you have a bunch of gain, and you sell that property, and you have to do it. You follow the rules of the 1031 exchange. You use usually an entity called a custodian, and they do all the admin for you. So they'll get the funds, and then you find the property to reinvest those funds, and it goes to those other investments, and boom, you're able to defer any potential taxes on the gain. And I'm talking about real estate investing. I'm not talking about your home where you live in. There is some tax-free gains that you can have in your ordinary income. I mean, in your primary home where you live, but it's up to certain limits. Whereas with real estate investing, you could do a 1031 exchange and sell them, buy a new property, increase those, sell them, and keep doing it over and over again until you die. So that's another great one with real estate. Yeah. So All right, let's go to the next one. Number 6, we're halfway there. Life insurance. So life insurance. And not just any life insurance, but specifically cash value life insurance. And so cash value life insurance is used by the wealthy so that the death benefit, the funds, when they die, are used to pay for estate taxes. Because currently estate taxes could be up to about 37% at the highest rates. Also, they could access the cash value of their funds on a tax-free basis. So they can use that to reinvest into their business, into real estate, or any other type of investment vehicle generally. And also the growth of their cash value grows tax deferred, so they don't pay any taxes on that growth. And some of these cash value life insurances, if they're structured correctly, the death benefit could also grow. And that's also tax deferred, meaning you don't pay any taxes on the growth of the death benefit as well. Yeah, and so cash value life insurance, some examples of those are like IUL's Index Universal Life, Whole Life, Variable Life. So either one of those would work, but life insurance is a big player for that, for the wealthy. So let's go to number 7 now. Number 7 is trusts, and not just any trust, because trusts are taxable, but a specific type of trust that I'm talking about is irrevocable trusts that are used by the wealthy. So these trusts, what they do is that they lower the wealthy transfer assets and also life insurance into these trusts, so that it reduces their overall taxable estate. What I mean by estate, meaning all their assets minus all their liabilities, it comes to a net worth, and that net worth is considered their estate net worth, by taking all their assets and minusing all their liabilities that they own in their lifetime or in their life. So that's what I mean by estate. Everything that a person owns, the net worth of that, assets minus liability. So by using those irrevocable trusts, they lower their estate, thus lowering their potential taxable estate into those funds, and thus are able to pass on their assets to their heirs or children with a lower tax rate, or potentially not even paying any taxes at all. And this is all legally done. Irrevocable trusts are very complex, so you need to go with your advisors, your estate attorneys, tax attorneys. Work with all your advisors, your investment advisors, and anybody else, so that you do these things correctly, because they are very complicated. But if they're beneficial to you and you do them correctly, yeah, you're going to be very happy. So trust, number 8. Number 7. Number 8, tax deferral. I'm sorry. Misspelled it. Deferral, 2 R's. It's DEFERRAL. For some reason I thought it was 2 F's. I don't know. I'm making a lot of these videos, so got a little error there. So tax deferral. So what I mean is that the wealthy, they use tax deferral to the maximum. So they invest in investments or in their businesses, and the value of those things grow. And so they basically, like I mentioned, buy, borrow, die. They buy the investments, and they let them grow, and they basically, some of them, instead of selling those investments, they just continue to let them grow until they die, and they pass it on to their heirs, like their children, so that they could inherit those investments. And the thing with tax deferral is that the growth in the investments generally is not taxed. But it would be taxed if they were to sell those investments while they're alive. So for example, let's say I invest in $10,000 in Microsoft, and I did that 20 years ago. And now my investment is worth, you know, 100,000. So that's a gain of $90,000. So if I were to die and I pass on those Microsoft stocks to my kids, their tax basis, instead of being 10,000, is going to be stepped up to 100,000. Thus, they're not going to pay any tax on that gain, and thus my estate is also not going to pay any tax on that gain. So tax deferral is used for, you know, for other investments like real estate and other things like that as well. So and so that's a great tool that you can use. And what the rich also do is that instead of selling those investments, they'll just leverage them and take out a loan and use the loan proceeds you know, to invest, instead of having to sell those investments at a gain. So number 8, tax deferral. Number 9 is tax efficient funds. Tax efficient funds. So what I mean by that is that there are funds that are actively that are managed or set up in a way that they lower your tax burden that you can invest in. You know, they're like index funds. ETFs are a great one as well, especially if you own them in a brokerage account, meaning outside of your retirement account, because they tend to be more tax efficient as opposed to a mutual fund. Mutual funds could also be efficient as well. Just gotta know what you're investing in. But tax efficient funds are a great way to that they help you decrease your tax burden, or are actively being managed to decrease your tax burden, to do you know, tax deferral and invest maybe in tax-free bonds and things like that. Another great one for tax efficient funds is the funds investment that are invested in oil and gas investments, because oil and gas investments, especially for high income tax earners, you know, W-2 income, I mean, that are earning 500,000 to $1 million or something or more, you could get quite a bit of tax deductions by investing in oil and gas. And that's, you know, that's of course if you do invest in those things, you could get, you know, up to like 60 to 80% of those of your investment amount to be deductible toward your ordinary income, which could be huge. And if you qualify as an accredited investor, it could even be over 100% of your investment. Again, it's kind of complex. You have to do it correctly, but yeah, a large potential for tax deduction there. So number 10. Let's go to number 10. Almost done here. Number 10 is tax harvesting. So tax harvesting, what I mean by that is that the wealthy, what they do is that it's called tax harvesting, which means that you're kind of harvesting or shielding yourself from paying, from having a taxable event or a taxable gain event. So like, for example, for some stocks, let's say you sell some stock at a gain. What you could do is also, if there's other stock that you own and you have that at a loss, you could realize that loss, sell those investments at a loss, and that loss will offset the gain. And so, or the majority of it. You could, now you got to do it correctly. You know, it's called tax loss harvesting, but you do that so that you're able to lower your tax burden and thus pay a lower amount of tax or no tax at all. And I mean, this is legal as long as you follow the rules and the requirements to do that. You know, you're in the clear, and you can do that. That's why sometimes you hear in the news like some, you know, big billionaire or just rich person, you know, had to sell some investments, but they did it for tax purposes so that they could lower their taxable their investment taxes, because they probably had some other gains that they had to report. So tax harvesting is a thing that the wealthy do. So number 11. Charity. So the wealthy, they give to charities, and there's ways that they can give to charities so that they decrease their tax burden, whether it's for ordinary income or for their overall estate. Yeah, and there's different ways they can do that. They can do that through specialized trusts. There's things I think called like crits and crats, charity remainder income trust, charity remainder annuity trust, and some other acronyms. But there's quite a bit of things that people can do for charity, while at the same time, because the tax code incentivizes that if you give to charity, you're also going to benefit tax-wise if you do it correctly. And they take advantage of that by giving money away to charity, and thus they benefit as well by lowering their taxes. And the last one, we came to the end. The last one, let's see here. The last one is advisors. Yes, finally. So what that means is that the wealthy, they work with advisors. They work with like registered investment advisors like myself, or people like myself. Also accountants, CPAs, attorneys, estate attorneys, tax attorneys, attorneys that help them form businesses, corporations, and whatnot. Whatever other advisors exist, but they work with their advisors. So because they don't know everything, they don't know all the laws, all the or all the things that they can do, and so us advisors, we help them do a lot of these things so that they not only grow their wealth, but they also protect their wealth and take advantage of all the incentives that are out there to decrease their taxes. So they invest in their advisors is what they do, because they also, by investing in their advisors, they invest as well in themselves. Yeah, so we came to the end, all 12 ways that the rich don't pay taxes, and that you can too, because you can do a lot of these things as well. So if you like, thank you for watching the video. Hopefully you gained some good information from these topics. If you feel that this video is very valuable, go ahead and share it to those that you think might benefit from it. Like and subscribe to my channel to also support me. That way I could continue to do more videos. And again, I wish you guys all the best in your financial life. And the more informed you are, the better decisions you'll be able to make. So until the next video, I'll see you then.